section we are going to run through is raising finance. So this section here is about maximizing the leverage that you can use for your property business. And as we run through the section, what I've done is I've broken the section down into different types of lenders that are available to us. So this is not really a section that's focused on any particular country or nation, as it were, with regard to lending. It's more so the different types of lenders that are out there and the types of deals that they lend on. So really what we're thinking of as we go on through this section, you want to be putting into your mind always what type of property have you got? Are you offering as security for it? And property, as I've mentioned before, is a fantastic business to gain lending and gain leverage on because it actually gives the bank manager that security straight away. So as we run through this section, what I'd like you to start sort of piecing together and getting the impression of is that there is a journey we take a property through with regard to the finance marketplaces, the condition of it, and all of those types of things. So we want to be making sure that that journey is correct. And you'll see as we go through these different types of lenders, there are lenders for some properties, there are lenders for other properties, and then there are final resting place lenders as we go on forward. So we've done the section starting off with kind of the institutional lenders, the banks, the main outfits that do the lending, and then after that we're then going to move into private investors and more flexible types of lenders. And then we'll have a little recap with regard to how we work, perhaps companies and company setups to work with the lenders as we go on forward. So what type of lenders? Or power of leverage. And the power of leverage is something that for the right property can increase our return on investment tremendously. So what we're trying to do here is we're trying to use that leverage to increase our return on investment so that we are able to maximize our investment power and investment potential through the different investments that we do. And you'll see there are some properties that allow us to borrow greater amounts. There are some properties that don't allow us to borrow such great amounts. The key thing whenever you're going to a lender, whenever you're looking to borrow money against your property, always what you want to have in mind is you want to have in mind, how do I get the lender their money back? Or more so, the lender's going to be thinking, how do we get our money back? And that's something that you want to not be blasé or short-sighted about that comment. You want to be bearing in mind that comment as much as possible. So the thought process is always going to be, if it's a rundown property, you're going to do it up, perhaps you're going to flip it on. If it is an income-producing property, then monthly income can provide the money back to the lenders. So always think of it. And I heard a statement or a joke, perhaps, said once about an underwriter. An underwriter is the person who actually sends the money out from the bank, out from the lender. And that underwriter is always the most downbeat, the person that is always the most critical with regard to a property sort of transaction. And this joke was that if you can imagine it, you've got an underwriter, he's woken up in the morning, looked out the window, and it's 35 degrees outside. It's such a warm day that they're worried the roads are going to melt. The underwriter is sat there having their breakfast, looking out of the window, seeing how hot sun blazing down. Then as the underwriter gets to their front door to leave their house, they pick up an umbrella. They always pick up an umbrella just in case it rains. Always, and that kind of, I think, highlights sort of the mentality of an underwriter, is they are always thinking of worst case scenario. So it's actually quite a nice filter that they're looking at deals very clinically, and they're always thinking, how do they get their money back from a transaction? Because if they're happy they get their money back, then chances are it's a good deal and your money will be protected as well. So underwriter is that person. So they've always got the thought process of how do we get our money back? Let's now go through these lenders or look at the lenders. So right from the start, we've got mortgage companies or bond companies, the most sort of formulaic and the most systemized with regard to property finance. Then we go right down to the bottom, which is joint venture partners, where there's no real rules to it. Joint venture partners sit there and you can set up the deal as to what rewards and what returns they're looking for as they go on forward. Let's start off by looking at mortgage companies. Firstly, what is a mortgage company? I think a lot of people talk about property finance and they use the word mortgage as kind of a blanket statement for property finance. That isn't the case, and here we want to be very detailed as to what different lenders we're looking at. So a mortgage company, what a mortgage company is a company that's been set up just to do property finance. It's not a bank. It's not a company that does overdrafts, bank accounts, or anything like that. It purely does property finance. And these mortgage companies, they don't tend to have sort of offices that we walk into and we apply. They have offices to deal with their administration, but we don't going to be walking in and applying via these offices. Mortgage companies get their business through mortgage brokers. So we will approach an introducer, and that introducer will then put the business into the mortgage company. The mortgage company itself doesn't have time to be dealing directly with the customers. It always wants an intermediary involved, and they package up the case, they get all the property details, they get all the information on the borrower. So a mortgage company is kind of a middle market. As I mentioned, it's not a full bank, so all they do is property finance. So here in the UK, mortgage companies cannot do loans under £25,001. So they do not hold the regulatory status to go under 25,000. So if you're buying very cheap properties, you'll find actually, although it's a very cheap property, you can't get a mortgage on it. And that's the problem that you may have. Then also, whilst we're talking about sort of minimum loans, what you'll find is, once again, in the UK, it is hard to get a mortgage under 50,000. Because the deal is so small, the rewards for the mortgage company are quite small, and therefore they're not really interested in doing those deals. So we've got to bear in mind that. We want to be bearing that in mind as we come towards our final strategy, which we'll go through at the end of this online training. So mortgage companies, now I kind of liken it and think of mortgage companies. Mortgage companies are a bit like the computer says yes or no. All the information gets put into a system, into a conveyor belt, and then sort of churned away, and it depends whether you fit the criteria as you're going on forward. So they are sort of 3 years address of property you're buying, those types of bits of information, then they do a credit check on you. That credit check is something that if you are looking to be an international investor, that is a hurdle. Because as an international investor, lenders, the UK lenders, are not legally allowed to credit check you. So we've got a case here whereby the mortgage company have a system that they go through, and there's not much sort of negotiation with the mortgage company as to their system and their process. They have 1,000 applications or whatever it may be every day. They just churn through them. So mortgage companies tend to be highest interest rates, about the lower end of the spectrum not highest interest rates, highest loan to value, lower end of the interest rate spectrum. However, mortgage companies much more prefer lending to private individuals rather than limited companies. Mortgage companies would much rather lend to private individuals, so that's sole trader investor, not limited companies. A question that I get asked a lot, especially with regard to international investing, is people are saying, oh, I've got a UK credit file, I've got a UK passport, I've got these different quirks, as it were, to my status. Am I able to actually go out and get UK mortgages? Now, the absolute rule is to get a UK mortgage, you need to have a UK tax number, a live tax number, and you need to be on the electoral roll. So those two items there is, firstly, you need to be paying tax in the country, and secondly, being on the electoral roll. What that means is you have to have proof of address, you have to be registered at the address of a property, and you are registered to be able to vote. So go into our political sort of elections there. If you tick those two boxes, there is potential for you to be able to get finance. It's still not a definite, but there is a potential. So when you're in a situation where perhaps you have a UK bank account, a credit file, unless you tick those two boxes of tax reference number and also registering to vote, you may get a mortgage offer, but it's a quirk, it's an anomaly, it is not a dead cert. And the worry is, the concern is that that mortgage offer comes out, everything's good, but when it comes to completion of the property, the lender may change their mind, they may ask for further information, and then you're stuck. So always think to yourself, if you want to get full UK lending, really you need to be here in the country and you need to be paying tax in the country. There are, of course, individuals out there who have managed to get UK mortgages and they don't tick those two boxes. It's an oddity. Yeah, it's an oddity to the system. It's not a definite strategy, and therefore I wouldn't base my property acquisitions on it, because you never know when you're going to get finance and when you're not going to get finance. You never know which way it's going to go. So mortgage companies, yeah, they're probably our dominant lender. Also, I should say, mortgage companies tend to be interest only as well. Something that you will hear mentioned as you go through investing in the UK, which we want to just watch out for, is the 6-month rule. You'll hear 6-month rule mentioned quite a few times as you go through your investing career. 6-month rule, to start off with, firstly, is a rule. It is not a law. It's not something we have to stick to. So what the 6-month rule is and what it states, in fact, let's backtrack to why it's there. The 6-month rule is there because in 2008, actually leading up to 2008, so 2006, 2007, a lot of very quick refinances were happening on properties. So a lot of investors were drawing their money out of the properties, doing refinances and going on to the next deal. And then in 2008, the banks, the government said we want to have a bit more control over the marketplace. We want to slow down this marketplace so that we have a bit more control over it. And also they want to say that investors have to have money in the deal for a longer period of time. So they came up with this 6-month rule. And what this 6-month rule is kind of a gentleman's agreement, as it were, between the lenders that says we will not let people refinance within 6 months of purchasing the property. So the concern, I suppose, that the lenders have got is making sure that you have owned the property. So if you are sat in the mortgage world and you're dealing through mortgages and you're doing properties that you're buying up and then refinancing, then in that case what we have to do is we have to always allow ourselves a budget for 6 months between purchasing the property and being able to refinance that property. So that's the thing we need to be checking and making sure we're happy with, is that time period is there. So 6 months is always it. Now, this 6-month rule can potentially also come up when we're trying to sell a property, because a buyer may also get involved in a 6-month rule, in that the buyer's mortgage company comes along and says that okay, we can see that the person selling this property has bought it recently, refurbished it, and now they're selling on. We understand that model. But they turn around and say the person who now owns the property has not owned it for 6 months. Therefore, it is a case whereby we are going to apply the 6-month rule to it. So they say, we agree a deal, we'll approve you for the mortgage, no problem there at all. However, what has to happen is they say that we have to wait to release our money until the current owner of the property, the person who's done it up, has owned it for 6 months. So what happens is you agree your sale, everything gets done, legals get done, mortgage offer gets issued, all the paperwork is there. It just has to sort of sit and wait until you can prove that you've owned the property for 6 months, which is absolutely fine and normal. And that's why, as we go back to sort of distressed properties and flips, I was mentioning we always budget for 6 months holding costs on the deal analysis section we went through. Always budget for 6 months holding costs in that property, because that then means that we know if we sell it quicker, we have a bonus rather than selling it later and having a disappointment. If you're selling to a cash buyer, the cash buyer does not get caught up in the 6-month rule. It's owning the mortgage marketplace. So there's no law saying we cannot sell our properties within 6 months. It is purely the mortgage companies just slowing everything down. Not necessarily in a bad way, but slowing things down. So watch out for a 6-month rule. By no means is it a massive gremlin in the marketplace. It's just something to be aware of and something to take note of as we're going on forward. So we just want to sort of bear that in mind as we're going on. So mortgage marketplace. Now the mortgage marketplace, as I say, it's like the computer says yes or no. So they have their particular types of deals that they like to lend on, and that's it. One thing that you'll find it is very hard to get a mortgage from any marketplace, any type of investor. It's very hard to get a mortgage on a property which is distressed. Because the mortgage companies, what they do is they look at the property and they say, how are we going to get our money back from this deal? So what the mortgage companies do is they sit there and they say the mortgage payment is, let's say £400 a month is the mortgage payment. They say we want to see rental income in excess of £400 so that we know we are covered to be able to get our money back from this deal. So what mortgage companies tend to do is they tend to turn around and say, we would like to see we would like to see rental income of 125% of the mortgage payment. So they would like to see a quarter more than the mortgage payment is, and that's their buffer, because they don't put into their figures mo money, operating costs or anything like that. They just purely say, so if the mortgage payment is £400 a month, they want there to be £500 of rental income coming in on that property. Once you can prove that there is £500 worth of rental income, they will hopefully move forward and lend to you on that deal based on your status. So, well, it's not based on your status. I should say dependent on your status. The mortgage is actually based on the rental income and based on that side. So what actually happens in a deal, and perhaps we should set a rule. Let's set a rule now, perhaps, that every property you're purchasing, you survey that property. So please do not purchase a property you cannot survey. So if for some reason you can't get a surveyor around the property, I suggest you leave that property alone and do not move forwards on that property. So there, what we're thinking of is, why should we survey a property? The reason is all of us together, whether we be international investors or local investors, we're not building's absolute experts. We might know a lot about it. We might have done an enormous amount of refurbishment. However, surveyors are people, and surveyors are sometimes called valuers. So valuer or surveyor. Surveyors are people who look over the properties and they have spent many years researching properties and studying for it. They actually go through what's called Royal Institute of Chartered Surveyors, RICS, and they go through exams with RICS. So what's happening is the surveyor comes and looks at the building, and he looks for any problems in that building, and he will look out for what the comparables are in the marketplace for value and for rental income. So when the mortgage company says, how do we get our money back from the deal, the mortgage company's surveyor is going to turn around to them and say, I've surveyed this building, it has good rental potential, or even this is what the tenants are paying. So we always like there to be a good amount of comfort for it. But mortgage companies are not really interested in distressed properties. because they are looking at rental income to get their money back, they're not interested in the distressed properties because by nature, the distressed properties do not have an income stream to them. So there's that, to bear in mind. So mortgage companies, I would say, are the finished resting place for your property business. Now, not many mortgage companies actually deal with limited companies. So the next one that we do is what I call bank lending. Bank lending is different to mortgage companies. Bank lending is direct from banks, so it would be sort of high street names that you know, such as HSBC, Lloyds, Handelsbanken, Santander, so the large organizations there. And these bank lending, whereas a mortgage company is just interested in a straightforward, simple buy-to-let property, bank lending will look at much more complex deals. And the difference between a mortgage company and a bank lending is bank lending, you're dealing with a bank manager. You've got someone reviewing the deal, looking over the deal, and taking control of the deal for you. So they're going to do an analysis. Now, we don't have to go and meet that bank manager. Our broker can do it for us. But the nice thing about bank lending is bank lending leads to conversations and email conversations to make sure the deal is correct. The good thing about banks is they have an enormous amount of money to back property projects. A fantastic amount of money available to it. What we've got to persuade them is we've got to persuade them that our project is good and worth backing. So straight away, the positive side, let's go through a couple of the positives to dealing with banks. First positive to dealing with bank is they do not have a 6-month rule, or they are not too bothered about the 6-month rule. So when we're dealing with a bank, we can easily get ourselves in a situation where we do a refurbish a building or a block of flats or a property. We go back to the bank. We've only owned it 3 months, but they will do a refinance for us. That refinance brings our equity out of the deal and allows us to then move on to the next deal. The negative side to banks is application procedure is generally a bit more paperwork, a bit more information that we have to gather. And also, most banks lend on a capital or interest and repayment method. So you're not getting an interest-only mortgage anymore with most banks. Not all, but most banks. Another positive to dealing with banks, though, is they will deal with private limited companies the whole time. So when you're investing and you're thinking potentially of going via company rather than sole trader, what happens is, by nature of what your business setup, you're going to end up dealing with a lot of banks rather than mortgage companies. And I think that's a nice thing. I prefer dealing with banks because it's a case whereby we can look at the situation of a deal, talk it through, and try and work that deal on forward. With regard to banks and also mortgage companies, both of them are going to ask that question, how do they get their money back? Mortgage companies are not interested in development finance. They're not interested in lending out some money against a plot of land that you're then going to build some properties on. What they are more interested in doing is lending to straightforward, simple buy-to-lets. Now, bank lending has an element of creativity to it, definitely. Bank lending has the position whereby they will lend out on properties, and they will lend out on those properties that are development projects, a little bit scruffy, not massive refurbs, but also finished products as well. And the types of things we're thinking of is large HMO properties, so large HMOs, blocks of flats, also portfolios of houses as well. A bank is quite happy to look at a deal and said, yep, you're buying 15 houses, we can see that, we will lend across the whole board of them as you go on forward. Might not be the best for you as the investor, but it certainly makes life an enormous amount easier. So same thing, banks looking how they get their money back. If you go to a bank and ask them to fund a development project for you, then you're in a case whereby the bank will look at this deal and they'll say, okay, we will potentially back this development project. But the thing that unlocks the deal for them is two factors. Firstly, you having fully approved planning permission. So you have to have the detailed planning permission there on that. And second thing that you have to do is you have to have gone through the tender process so that you are able to appoint builders. So that's those two factors, because the bank, if they're lending you development finance, they need to say, yep, we're going to get it back in 12 months' time because the site will be built out and sold, or whatever it may be. So banks tend to be development lenders and also investments. So you will get into a relationship with a bank whereby they say, we'll back your development, we'll give you the money for your development, and then what we'll do is we'll refinance if you want to keep it as you're running on forward. So bank lending has some great attributes to it. I think quite a few people shy away from bank lending because they're scared of meeting the bank manager. We don't need to meet that bank manager. It's something our broker can do for us, or we meet them whenever we're available. However, don't forget the bank manager is a commission-based earner, as it were, or a salesperson for the bank. They're looking to get loans out their door. I tend to use a lot more bank finance than I do mortgage finance because I find that flexibility. And one of the key things, if you're an international investor, one of the key things to be thinking of with regard to the flexibility is being able to invest in the limited company. So when we were talking about mortgage companies, what we mentioned was the fact that the mortgage company likes you to have a credit file, likes you to have a tax reference number, and likes you to be based in the UK. If we're investing through a limited company, what we do is we achieve all of those items through that limited company. So we actually get ourselves in a situation whereby the company is the borrower, not us, the company is the borrower. And there what happens is the company is based in the UK, which makes the banks happy, and also the properties are in the company, which makes the banks happier as well. So bank lending, a great tool. Loan to values and things, when we're looking at bank lending, here in the UK, you're looking somewhere between 65 and 75% loan to value. So the loan to values are a little bit lower than mortgage companies. However, the ability to refinance faster is there with banks. So if you've got a lot of your own money in a deal and you want to get that money out to do the next deal, then bank finance is one of the best places to be looking at. Then the next and the third institutional type lender is bridging finance. Now, bridging finance is quite an interesting realm. It's something that has built up and really increased over the last few years. And I think that's because so many people have sold off their equities portfolio or been made redundant by one of the big banks or something like that. Because now that's happened, what's happened is there are a lot of people with money that they want to put into bridge finance, and a lot of bridge finance companies have popped up. Now, the bridge finance element is, how do we talk about? So bridge finance, it's scary stuff. It's scarily expensive property finance. I kind of liken bridge finance to a campfire. If you can imagine, you're sat round a campfire, we'll go off camping, you're sat round the campfire, everyone's having a glass of beer, and stories tend to grow more and more out of control, and probably more and more out of reality as well, that the stories grow to. But whilst you're sat around that campfire, the fire keeps you warm, keeps you happy, even here in England and the English climate. So that campfire sort of protects us, keeping us warm. However, if we decide for whatever reason to sit on the campfire, we get burnt. And this is exactly the same with regard to bridge finance. Not you get burnt, but financially you do. So bridge finance is a great avenue, a door into a property deal, but we don't want to be sitting on bridge finance. We want to be sitting much lower interest rate. And bridge finance tends to be somewhere in the region of 1 to 1.5% per calendar month. So it can be a very expensive sort of way of doing a deal. So you think 1.5% a month, why would anyone pay that interest rate for that type of loan? Well, the reason people go to bridge finance, and the reason that it is a marketplace that is very, very busy at the moment, is because bridge finance will take on almost any property. They are not worried about the condition of the property. They are absolutely fine with that. So they'll take on loads and loads of properties that other people wouldn't. So what the most common route is, bridge finance to buy a distressed property, then mortgage or bank lending to refinance it if you're going to keep it, or we flip it on out. So that depends what our goal for the project is. If our goal for the project is flip to make some cash flow, we just repay the bridger via the sales money. Then if our project is to flip the property on, we sell off, or if it's to keep, we go to a bank or a mortgage company to refinance. So bridge finance is very, very useful when we're looking at those rundown properties, trying to make them look a bit better. So the three that we've got there, so we've got mortgage companies, bank lending, and also bridge finance. Those three ones there are the industry sort of standards, as it were. They are the ones that go through lending to your property business. They are banks, so they should have a decent amount of money available to them to be able to do your property deals as you carry on. But most of the time, they'll be lending you somewhere between 65 and 75% loan to value. Just a little tip, you often end up with lending companies offering sort of terms, and you come out with the terms and you think these terms are too good to be true. Then in that case, if they are too good to be true, walk away from them. You know, we want to be thinking, is this lender ever going to complete? What's the situation with regard to this deal? i.e., who's offered on it, who's trying to buy it, and those sort of things. So bridge finance is a good tool. It is not for the faint-hearted, and I'd say it's not for your startup property. But our mortgage brokers know a lot about bridge finance and a lot about how to use it as you're moving your property business forward. Next section we're going to go through is private lenders. So those three there, yep, they're the more institutional, the more bank-type lenders. The next section we're going to run through is private lenders. Now this is where it changes and takes a slight different sort of tact, as it were, to what the lender is looking for. Because we're dealing with private investors, what we might be trying to do is link the private investor up with the bank. So the private investor doesn't have enough money to back the projects completely. So the thought process here is, if we're working with private lenders, then we need to find availability for a second charge on our property. And what that means is a second charge. We have, so here in the UK, when a lender takes out a loan on a property, they take a charge on that property. That charge is a document controlling who can come in, who can go out of that property, when it gets sold, and things like that. So it's quite easy to end up with a second charge if you grant a friend perhaps that second charge. I think what you want to be bearing in mind is if you've got the sort of the main lending there and then second charge coming in here, these private lenders can help out. And there seems to be an enormous marketplace for them at the moment because they are fed up with getting almost no return from banks, money in the bank. So what rates work for us? What's more flexible? Be more flexible. So you may have a private investor who wants 2% a month. They ask you and say, can you provide 2% a month? You look at them and say, well, I can afford 2% a month, but it's got to be on my terms of lending. And then you'd be looking to agree them. So they might well be putting all of the money in, and you end up with actually no money in the deal. Because what that gives you, if you're buying a flat, doing it up, selling it on, once you've actually got rid of that flat, hopefully you'll be able to repay both of your lenders and end up with a profit yourself. So if we end up in a situation where we've not put any money into a deal and we've coupled these two up, private lenders and bank lending, we might end up with no money in the deal, which is great as we're looking to increase our deals and make them sort of bigger and better and more profitable as we run on forward. So private lenders is a great thing. Now, what sort of interest rates work for private lenders? I find an interest rate that really does sort of start them coming into your realm is 10%. 10% is a rate that lenders seem to like, and the reason they seem to like is because they see it as a double-digit return. That's what they like talking about. Next thing they might like is security. So the flexibility as you're going on through. But 10% or even 12% is another good interest rate to be bearing in mind when meeting up with private investors. Private investors you want to be a little bit careful of because it's a marketplace where you can end up wasting a lot of time. If you meet up with someone who says they're going to invest in your business, you want to watch what amount of time you spend with them. So you might have 19 meetings. All of those meetings sound very, very positive, and then you get to the end and they never actually move it forward. So I work with several private investors. I have a smaller group, 3 or 4 people who actually sort of back all of my projects as they're in that distressed state without planning permission. So I don't have that worry with regard to it. But each time I know they're around, I pop in, I see them, I'm emailing them regularly. I'm just making sure that that contact happens as it runs on through. Also on the lending side, one of the things to bear in mind is security. One of the things we can offer our private lenders here is we can offer our private lenders the ability to have that legal charge on the property. Who would act for us to give the lender security? That would be our lawyer who is completing the purchase for us. So that purchase will be completed by a lawyer and they will treat this private lender exactly like a mortgage company and making sure that they have their security. So the solicitor will turn around and say, I act for you in this deal. I don't act for Harry when dealing with money. Do be aware that the solicitor cannot advise you in the transaction. They can only draw down the actual money. So if your investor is very, very cautious, they might have to send the money to the mortgage company, which is fine. It's no problem at all. So that's private lenders. Private lenders are a great tool to sort of take us forward. And there, hopefully, we're looking at sort of tens of thousands that they're looking to invest to make it worthwhile us cutting the deal with them as we run on forward. So private lenders. Next section that we're going to go through is angel investors. Angel investors are different to private lenders. A private lender is a person who is looking for an interest rate as their return on the investment. So they'll be looking for, as I said, 10, 12%. And private lenders tend to perhaps be lending a bit more money than angel investors. Angel investors will be a smaller sort of investment that they'll be putting into your business, and they will potentially be, even more on a more friendly basis. So angel investors, once again, similar sort of interest rates, 10 to 12% interest rate, but they will be investing in your business rather than lending to a particular project. So they won't necessarily be worried or bothered about security. They will be thinking more so about looking to invest in your business, put some money into the business, so they will do a loan agreement into potentially a limited company. So as we think of the two different elements there, private lenders are potentially people putting in, they might replace the mortgage company, or they might be what's called a second charge lender, so they sit behind the first charge lender, whereas angel investors are putting a bit of money into it. So angel investors often end up sort of funding your deposits or potentially just the refurbishments as you've gone through to help the project on its way. Once again, angel investors can have security, but it is easiest to work with angel investors as people who just do a loan agreement into the business. So that's why once it's quite easy to work with limited companies. And we'll talk about limited companies in a moment as we go through as to what security we can offer. So angel investors there, thinking really they are the people that potentially give us the smaller amounts to help us going on forward. Next one is joint venture partners. Joint venture partners. Now, a joint venture partner is someone who wants to be involved in your project, but perhaps you as the investor don't want to pay them a monthly interest rate. Perhaps it's an 18-month development project that you're doing. It's going to be quite a long sort of cycle to go through this project. So what you're thinking of is you're thinking, well, I don't want to pay this person a monthly interest rate because that monthly interest rate is going to be coming out of my pocket at a point where I don't have a rental income. That's the concern that we've got. So on that side of it, joint venture partners, one of the most classic sort of joint venture tie-up is an investor who's got some money teaming up with a builder. So this is very commonly, you've got a wealthy individual who perhaps sold their business, they're in semi-retirement, they say, I still want to be involved in the property business, however, I do not want to be on site running the projects. So you've got the financial backer and also the person with the deal. And we'll probably sit, most of the time here, we'll sit as the person with the deal. We may not be doing the building work ourselves, but we've got the power team to be able to do that building work as we run on through the project. So thought process here with partners is bringing them in. Another thing we can do with partnerships is to help us move forward is actually to bring the builder in as partner of it. And this is in the development strategy. When we're developing properties, quite often the lender, the main bank who's involved in the deal, may turn around and they'll turn around to potentially to me and say, Harry, we like the idea that you're going to build 30 or 40 flats. That sounds good. That sounds very promising project. But Harry, you're not going to build 40 flats. Who is? And they're then going to start asking about the actual builder themselves. So the actual builder that they're going to be looking at. So what you might do to make the bank happy is you could potentially partner up with the builder and the builder will then come in. So when the banks say, Harry, we're not going to get our money back from you because you're not going to build the flats, you can turn around and say, but meet my partner, the builder, and they are going to be the person doing the building project. So it takes the pressure off us to satisfy the bank that they are going to get their money back. So that's what we're thinking of. So as we run through each of these sections here, what we want to think of is we want to build a bit of a process with regard to our property business of at what points we step into different points in the marketplace. So by that I mean, if we've got a distressed property, we used to be able to get mortgages on distressed properties, but now it's a lot harder. So there is a definite model, a really, really big model that's building up in the marketplace now that run down distressed properties, they go to bridge finance. So you go bridge, refinance, bridge, sell. It always seems to be that stepping stone process that we run on through. So we've got bridge refinance, bridge sell. Is the important factor that we're looking at. So there, what we're thinking of as we go on through those projects is, as I mentioned, bridge is scarily expensive finance. It's not stuff we want to sit on, but with regard to bridge finance, it gets us into the deal. So we may have a main bridge finance company that lends us, say, 65, bridge tends to lend at 65% of the purchase price, 65 up to 75%, then we may have an investor that helps us with the rest, or alternatively, we put in the rest of the deposit and an angel investor helps us with the refurbishment. We then do that property up within the 6-month window, And then once the property is done up, we are then able to sell it on out to the marketplace. So, or alternatively refinance. So every time you're looking at a property, you want to think, I need to borrow some money. So if you're looking at a property and you think, I want to borrow some money for this project, what you're thinking of is you're thinking, okay, when you present that property to the bank, whichever bank it is, you need to be able to say to the bank manager, this is how I'm going to get your money back. Now, most of the time we actually say this via the mortgage application form. We don't physically say it, but have that in mind. So if this is a rundown property, you go to a bridge finance lender, the bridger says the property will be worth 100, it's currently worth 70, so we'll lend you 50. And they're comfortable with that transaction. A mortgage company won't lend on that property because the mortgage company look at the property and say, it will be worth 100, it's currently worth 70, but what's the rental income? If there's no tenants in the property, then the rental income is zero, therefore there is no chance of the monthly money coming to the mortgage company. So what we're doing is we change, and that's how we work as investors, we change the positioning of that mortgage or the property, as it were. So we start off with the property in a rundown state, so it's no good and not got a rental income in it. Then we make it better and better and better so we can take it forward. Now, one thing also that I should mention in this section, and this will be quite an important factor for perhaps those of you that are borrowing or building up a property business in the lower end marketplaces, what we want to be thinking of is some of these cheap properties, and I know from my personal sort of investing experience, there are £20,000, £30,000 properties around the country that rent out okay. No major problems to them. But what we need to think of is those properties are too small to get mortgages on. The purchase price is too low. However, banks will lend on a portfolio. So if you took 10 cheap properties to a bank, or even 3 or 5 or whatever it is, if you took those properties to a bank in a limited company and said to them, will they lend on that portfolio, banks will do that. Mortgage companies won't. So if you're going down the line of building up a portfolio of small little investment properties to build your experience and build up as quickly as possible, then you've got the potential to go to a bank manager and say, yeah, I'd like to I'd like to refinance 5 of my properties or 10 of my properties. And as the numbers become a lot more interesting to the bank manager, he will do those loans for you. Whereas a mortgage company, it has to be done individually. The mortgage company sit there and say, well, each individual property is not worth 50,000, therefore we're not interested in lending on it. And we've got that balancing act that we have to bear in mind as we go on through our investing sort of career. So you can see as we've gone through this section, there are different types of lenders. Now, a lot of people that are watching us, a lot of you guys that are watching it will be overseas investors. So what is the norm that you'll be looking at? And I avidly believe there's no rules to finance. Yeah, if you've got a good enough deal, there's so many different ways out there potentially of funding that deal that we've got the ability to push ourselves forward and make ourselves a lot better prospects to the lenders. But as overseas investors, I mentioned yesterday, or I mentioned earlier on in the online training, that a lot of overseas investors invest via UK limited companies. The good aspect of investing via a UK limited company is that UK limited company has its own tax file number. The company has its own, it is a UK citizen, I suppose. It's a UK base. So without you having to personally come into the country, it gives you that status of building up. So the norm is for an international investor to set up a limited company to invest via that limited company, because then you have that tax file number, you build up that status. but always be thinking if it's rental properties that you want to get lending on, imagine it that when you want bank lending on that limited company, you need to be able to, you don't physically have to do this, your mortgage broker can do it, but you need to physically imagine that you can walk into the bank and say, here's the property, here's the tenancy agreement, here's proof of rental income coming in. The bank manager, because the bank manager will be a little bit nervous. We've got overseas directors here. However, if he can see that the property is owned by a UK company, he's happy because he knows the law that controls that property. And if he can see the rental income, he can say, yeah, fine, I can see it's rented. It's almost like you as the director of the company are not required anymore. So start thinking of that as we go on forward. So always think, what's the positioning of it? A tip, a suggestion for you to be thinking of is I would set up a new company for every lending relationship. So there, if you've got potentially 3 or 4 different joint venture partners that you're going to be working with, then what you want to be doing is setting up a new lending relationship per company. Yeah. So, because that way, as you go into new joint venture partnerships, then you can sit down with the partner and say, here's a blank canvas, there's a new company that you're going to get involved in. It's only us that's involved in it. And then as you go through doing the accounts for that company, as you go through looking into that company, you can have completely sort of transparency with the bank accounts and the situations there that you're going to run through. So I would always suggest a new company per lending relationship, not necessarily per deal. So if you've got one partner that you work with and you do many, many deals with them, you can keep going in that same company. You don't have to do a new company per deal, but a new company per relationship, because that way, if the partner has a problem, or even if the bank has a problem, as we saw in 2008, some banks got into troubled territory. If they have a problem, it doesn't damage, it doesn't contaminate the whole rest of our business as we're going on. Other factors that we need to be bearing in mind when we're looking at lending, be asking ourselves questions, how does the bank get their money back? We've asked that question with regard to sort of the deal and the strategy, so doing up the property and then selling it on, doing up the property and then renting it out. Each of these elements are absolutely fine with regard to increasing the potential for the bank to get their money back. But let's just run through a bit of a list here. First thing that the bank is going to look at is your solicitor. So what you may find is you get bigger and bigger deals, you actually have to use a bigger and bigger solicitor's firm, because every solicitor's firm has something called professional indemnity insurance, often abbreviated PI insurance. That PI insurance is the protection. So if your solicitor makes a mistake in this transaction, what happens is that mistake is then rectified via their insurance policy. So the bank gets back their money via the insurance policy. So what will happen is, let's say, for example, you're doing a £10 million deal. Your solicitor's firm will need to have insurance for that £10 million transaction. So they'll need to make sure that they're in place for it. So the solicitor is one thing that the bank will look at, and that's it. And that's a nice thing for us, knowing that the bank are checking the solicitor as well. And you'll see as we go through kind of this training, you'll see there are a lot of checks that are happening, a lot of people that are making sure that the transaction is as correct as possible. You know, a lot of checks happen behind the scenes. Next person that's going to be looking over the deal is the valuer. We made an agreement earlier on whereby we're saying that we survey every property. Survey, valuer, same person. So here the bank is going to send out a surveyor. So whenever we are looking to borrow money, a surveyor is going to be involved in the transaction, checking over. And they are going to do a survey of the property to make sure the building is a good property, but also they are going to be looking over the building and checking over the building to make sure comparables of what it's worth purchase price and comparables of what it is worth rentally as well. So always bear that in mind. But I think even if you are buying a building for cash, please set a rule that you get a survey done for that property as quickly and as possible to make sure that you are happy with that. Next element for the lenders, whether it be private lender, whether it be institutional lender or bank, next element we want to be thinking of is security. Security is something we want to bear in mind. So making sure that if it's first charge, second charge, loan into the company, whatever it may be, all of those bases are covered. So just checking to make sure that that happens as we run on forward. So security there. And final thing the bank is going to look at is business structure. We talked earlier on when we talked about business structures, I mentioned that there is quite often a bit of a war, a bit of a playoff between the lending world, the finance world, and the accountancy world. What lenders like to know is lenders like to know who the shareholders are, who the control is, where the control is. Ideally, a lender will like the profits of that company, so the shareholding of that company, to be in the same jurisdiction as doing the loan. So if it's a UK company, they like the shares to be controlled in the UK as well. So just bear that in mind. If you start going into trusts, offshore companies, or if other people start owning, other companies start owning the shares in your company, do bear in mind that there is a potential that your lenders will become a little bit more nervous about the transaction as they're going on forward. The next thing we need to be putting forward to lenders is a bit of an area background. So put together a bit of a CV, area background, your background, and your power team. So all three of these elements, highlight them to lenders. It may be in the email that you send over for the transaction, whatever it may be as you're moving on forward, just to make sure that you're happy with this business model as it goes on. So looking at that background side of it and making sure you're comfortable and happy as you move on forward. So area background, regeneration, what's happening in that area, what's moving forward in the area, your background, what deals have you done, and your power team. And that might be the builder that's there, what projects have they done. If it is a case that you have done deals previously, have some before and after photos. Have a nice pack, a nice presentation that you can take forward. But as much as anything, what you want to focus on is what are your goals, what's your strategy, and then where should you invest. Always remember those stepping stones as we're looking at it. Because if this property falls outside of your goals, what's the point in doing it? The bank may give you the money to do it, but you're taking yourself away from the goals, and that would be a concern to us. So always thinking through that. So that's a bit on finance there. That's some of the tips on the finance market. But definitely, if it's a good deal and it's clear the bank are going to get their money back, then you'll find there's quite a few banks that will back projects. What changes is the interest rate as you're looking at and getting involved in it. So the interest may change as perhaps the status of you and the status of the deal changes. But I've just put together a little bit of a slide here. And this slide sort of shows the process. So we start off by purchasing a property, and that might be a rundown property that we're going to be purchasing. So we purchase that rundown property. We then add the value to it. So we refurbish the property, we make it bigger, we make it look nicer, whatever it may be. We add that value. Once we've got the finished product, we then make a decision. We either refinance the property if we're going to be keeping it for rental income, or we sell it off if it is a deal that we want to be taking a capital hit on. So at the end of the project, we think, is it capital, is it cash flow, refinance, or sale as we're running on through it? And you can see as we cycle our money through the deal. So we then put that money back in. And what we're looking to do is perhaps build the investment pot. By doing flips, we build that investment pot. We might invest 30,000 into the deal, then we get it back as 40,000. Then we put 40,000 into the next one, we get it back as 55, and the cycle starts building as we build our investment pot. And what we must be doing is always keeping our eye on that bullseye, keeping our eye on the target as we're running on through. So really focusing on it. Just put a couple of photos here. You can see a bit of a rundown kitchen. And this one that I've put in here, this building looks, well, it doesn't look okay. It looks a pretty ugly building. But this type of structure, if you see anything that looks at all similar to this, in fact, I've got another slide in the social housing section that we'll go through. If the building looks anything similar to this, be very skeptical of that building, because that building is something called concrete construction. Now, concrete is a construction method that's been used in building world, all over the world, a lot. But there is a particular period in the UK, tail end of the 1960s and early 1970s. Those periods are where what happened was they were using a lot of concrete in the construction, but it was steel reinforced concrete that they were using. And that steel reinforced concrete, what they did was they poured all the concrete around the steel, but they put a lot of chemicals into the concrete to make it set faster so they could build faster. Trouble is those chemicals have now eaten all of the steel, and they've ended up in a situation where it's now steel reinforced concrete with no steel left. So those properties will be unmortgageable. So what you'll find is there, if you've got a photo of the property, send the photo of the property to your finance broker. Your finance broker will quickly look at it and they may well say, we might have a problem with this property. It may be concrete construction. So there are a couple of things that are tough to finance as you've gone through, but those details will come out. But I do think, you know, over my investment career, there have been a couple of transactions that I've struggled to get funding for. If those transactions, and if you are struggling to get finance for something, then it might be the finance market telling you this isn't a good deal. They may know something that you don't. So if it's something tough to finance, then make sure you do your check and you're not too gung-ho with it. But that's the section on finance. That finishes off the section on finance. Very much, I think, take a phrase away from this section saying if the deal is good enough, the money will come to the deal. So that's the section on finance.